focus on the very high level of negative real yields. It's a situation that can't continue forever, obviously. It only continues for as long as the establishment central banks can sit on rates. The reason they have to sit on rates is because, having distorted the market, they can't allow markets to come back, as it were, and have a true reflection of the situation. I mean, just imagine with all the malinvestments, the non-productive debt in the private sector, which has been taken out on the basis that interest rates have been anything from 0 to, say, 5% over the last 10 to 15 years. I mean, it's completely unrealistic with prices having moved up, as you rightly point out, in the United States, officially by 7.5%. I mean, we could go a bit further and say that unofficially, I mean, if you look at shadowstats.com, they're saying it's 15%. Okay, we, give or take 10%, we're up at least 7.5%. And as you rightly say, that implies a negative real yield of at least 5.5%, at least 5.5%. When it comes to government finances, of course, the assumption is that governments can continue to borrow at these very low interest rates. And if interest rates rise, as implied by very high negative real rates available on their bonds, then that is going to disrupt government finance. And if you disrupt government finance, coupled with the problems in the private sector from rising interest rates, you have got a global economy, because it's not just America, a global economy that faces what Keynesians call a recession, a slump, a depression, however you like to call it. I prefer to just describe it as a downturn in economic activity, as the malinvestments are sorted out. I mean, what Joseph Schumpeter described as the process of creative destruction, that has got to take place. And the whole objective of monetary policy is to stop creative destruction taking place. And it's been like that. And the result is that the distortion has just built up and built up and built up. There is another aspect which nobody is talking about, and I've been researching it for my article for Gold Money, which is being published tomorrow, and that is the situation of the central banks. People seem to think that the cycle of credit, the boom and bust, as it were, is something that is restricted to the commercial banks. So far, yes, that is true. But we now have a difference, because the central banks now own an awful lot of bonds. So we need to think now not just about the effect on the commercial banks and how that interacts with the real economy and so on and so forth. We would also think about the situation for the central banks. Central banks now have an enormous amount of their government debt on their balance sheets, which they're carrying at very, very low interest rates. So if you get a rise in bond yields, in the yields of the bonds on their balance sheets, that means that on a mark-to-market basis, the value of those bonds falls. Now, this is actually sort of hidden. It's hidden in two ways. I mean, the Bank of England hides it because they have an off-balance sheet special purpose vehicle which holds all these bonds. And under previous chairmanship, I think going back to the time of Lord King, when QE first was introduced, the Bank of England managed to negotiate with the Treasury that any losses on QE be reimbursed to the bank by the Treasury. So the result is they don't have to carry a note in their accounts saying, we've got this elephant in the room. Yep. I mean, so far we're looking at potential losses in the region of £100 billion for the Bank of England. It wipes out, if it was accounted for property, it would wipe out all the equity on the Bank of England's balance sheet many times over. If you look at the Fed deals with this in a different way. And in a sense, it is justified, because the average maturity of US Treasuries on the Fed's balance sheet, I don't know the exact figure, but the US Treasury market tends to have a shorter overall maturity than most other bond markets or government bonds. what the Fed does is it carries the US Treasuries and agency debt on its balance sheet at its face value. So you just don't see what the true value is. Again, the rise in yields so far has wiped out all the equity on the Fed's balance sheet. The same is true of the Bank of Japan, which famously has got huge amounts of government debt. It's been doing QE since the year 2000. It was the first central bank to do QE. And not only does it do QE, but it also invests in ETFs in the stock markets, sort of equities. So it's carrying equity investments on its balance sheet as well. So that is, again, it is seeing its equity wiped out. The effect at the moment is marginal, because what happens in the JGB market is that we're looking at rates, say, on the 10-year JGBs, which have risen from a low of about 0.03% to 0.22%. The price effect of that is obviously not nearly as great as you have seen in the US Treasury market, where even on the 5-year bond, the yield has risen from around about, I think, sort of 0.4, something like that, or lower, and it's now currently running at just under 2%. So there's a bigger price effect on that. But the real horror story is the ECB. I mean, that is staggering. The problem that the ECB has is that it hasn't got a government to rescue it from negative equity. It is already in negative equity, incidentally. And then you've got the position of the national central bank. The Bundesbank is deep underwater. I mean, it really is, hugely. I mean, we're looking at in the world of commercial banking, we sort of see asset to equity ratios of, sort of 10, 11, 12 being really sort of a bit on the rich side. And, it's a setup which is going to end up in a crisis. I mean, but in the central banks, I mean, to see asset to equity ratios of over 150 times is not unusual. It's commonplace. So it doesn't actually take very much of a rise in interest rates, a rise in bond yields, to wipe out the central banks. Now, I don't know how that resolves. I mean, I can see in the case of the UK, the Bank of England turns around to the Treasury and says, well, thanks very much for the guarantee, we're calling it in. And what will happen is that the US Treasury won't sort of start sacking workers to pay the Bank of England's bill. It'll tell the Bank of England, well, you just borrow more so that we can pay you, And the whole situation, I mean, I can see how that one would be resolved, if you like. That's what basically will happen. But, anyone who's got an ounce of common sense sort of sitting back and thinking about this will think, oh, hold on a minute, this is a complete bloody scam. We can't go on like this. I mean, what does it mean? Does it mean that the Bank of England as a counterparty, I've got pound notes and, 10 pound notes or 20 pound notes, that is my exposure to the Bank of England. Should I trust that if this is the sort of game they get on with? I mean, if that's bad enough, I mean, the position in the Eurozone is horrific. I mean, there's the only way to describe it. And without having a bank, as a government to turn around to and say, it's not a problem because, the German government has guaranteed our equity. Hold on a minute. That is not the situation. Nobody is guaranteeing the ECB's equity. And if you think that Brussels is going to come up with the money, I mean, forget it. They couldn't organize light refreshment to a captive audience. So the whole of that situation looks like being a fiat currency catastrophe. And then what happens to the banks? I mean, if we start getting these sort of counterparty failures with the central banks, nobody's going to start dealing with the commercial banks in the Eurozone. And if they haven't gone bust by then, they will go bust. And also, we've got the situation of the repo market, which, as I've said before, in the Eurozone is well over 10 trillion euros. That basically is going to go overnight. Now, that's a bank credit contraction of over 10 billion euros, like that. So, this is not looking good. And I mean, it makes me think that, these rising bond yields getting back to your point, Daryl, has actually got these unexpected consequences, which we're not really fully thinking through. And it tells me that once this house of cards starts falling apart, I think the falling apart will speed up and it'll be a very, very rapid event. So the time, we don't have the time to be able to sort of sit down and say, well, we can see this, we can see that, and so on. And so we can plan for the future. We're running out of the sort of time when that's the case. And to get to your point about the crisis, repeating, sort of with regularity every decade or so. The point about a crisis is that you wake up one morning and say, oh my God, what's happened? Overnight something has happened. And, and it doesn't have to be a war with the Russians in Ukraine or something like that. I mean, it can be a financial thing. It can be rather like the Credit-Anstalt failure in 1932. Suddenly a relatively unknown bank falls over and then the whole banking system collapses. So I don't know. I don't know what will trigger it. But what I do know is that the more I look into this, the greater I see the dangers being.
Before we continue, help us clicking that YouTube like button and subscribe now to our channel. This shows the algorithm that you valued this information. And it helps us spread that message. Sharing is caring. And now, let's continue.
Do you want to know one thing about crypto? I made over 3000% in profit in a few weeks. Fact is, the traditional financial system, the traditional money system makes you poor, not rich. If you want to earn $500,000, $1 million, you have to wait until you're 50, 60, 70 in the traditional financial system, and you probably will still be broke. And you will be old. This is not a sexy combination, as you can imagine. But the question is, how can you start in crypto and make these profits? Where to invest? Where to start? My name is Gunnar and I'm from Germany, as you can hear, and things are a little bit different in Germany. More about that later on. Fact is, there are lots of different cryptocurrencies. It's a gigantic universe where beginners and professionals get easily lost. But there is light at the end of the tunnel. There are 7 key steps you need to follow to become successful in this market. You have to know them, and if you fail one of them, it's literally impossible to succeed in this market. Just an example, one of the key points is your exchange, and one of the biggest are, for example, Binance and Coinbase. These are trusted and well-established exchanges, but, and this is a big but, you won't find the super profitable coins on those exchanges. The unknown super profitable coins that get gigantic profits are not traded on those kind of exchanges. They are traded on much smaller insider platforms that are barely known. And I can tell you what those super secret exchanges are and why they are so profitable. And another super important thing are the right information sources. The point is, the internet is gigantic. There are hundreds and hundreds of YouTube channels, blogs, pages, and much, much more. And there are also market makers and influencers. For example, Elon Musk, he is not a crypto guy, but the moment he recommended Dogecoin, it went through the roof, to the moon, so to say. But why did he recommend it? Where did he hear it from? He didn't hear it from newspapers. And believe me, he is listening to someone. But you have to know who, and you have to react before he is reacting. This is really, really important. And these are only 2 of the 7 steps you have to follow in order to be successful in crypto. And if you want to know all of these steps in much more detail, and if you want to have a comprehensive checklist, here's what you should do. There is a link below this video. Click on this link and you will get the opportunity to subscribe to my channel. Click on the link and you will see a video where I explain the next steps. So see you soon. Click on the link now. I'll see you there.